Well, welcome back to Facebook. I'm Joe Malandrino, Global Markets Reporter at Nasdaq. Joining me today is Suzy Smith. She's a Portfolio Manager for Strategic Portfolio Solutions. Suzy, I'm so glad to finally have you in New York with me. And today I want to discuss some common mistakes that premium sellers make in particular. There are three things that you look at.
Well, let's start off with how you become a premium seller to begin with. If you are going directionally long an option, you immediately have to get right time, price, and direction. Therefore, 80% of all directional options expire worthless. That's when you can flip into being a premium seller. In being a premium seller, you're taking in a credit for what you do. So you're getting paid ahead of time and you have a very defined risk. The problem happens, or the problem occurs when people go in and they don't pay attention to when an earnings date would be. Or if they're selling an index, they'll be too high up close to the money, so they're going to get whacked really, really hard if the market comes in at all. You need a wide variance in the charts in order to be an effective premium seller. Biggest mistake I've seen made is you put on too many contracts for your account. It's best to leg in a third, so that you have the opportunity to massage the position, so to speak, so that you can make it last. The biggest one that I've seen is that they go too far out in time in selling their premium, trying to get a greater credit, instead of keeping it somewhere short term between a week to a month, where you can consistently turn your money over and over and over again.
Right, because if you have it too long, then you're going to run the risk of an earnings event.
Correct.
Being in there as well. Because so let's explain it to the audience. So when you have an earnings event, you're always going to get that spike in vol, which is going to distort the pricing with your options, and that's how you could potentially lose out on the premium sell, because let's say you sell $1, if you're going to get that spike in the premium, it could be up to $1.50, and then you've lost 50 cents.
It could go to $3, $6, all depending on what the event is. It's not worth the risk.
Right. Well, here's a common question that we get a lot. Selling premium, and it has been a great strategy in this particular environment, since it's been a very low vol environment. Nothing comes for free. If you sell premium, it's a great income strategy, but should it go against you, you have to also be willing to want that stock as well. Could you also use it as a stock replacement strategy?
That's the proper position sizing. If you are going to sell premium, whether it be a naked put or a spread or a condor, any of those strategies, you have to be willing to put the stock at that particular price at that particular time. And where people run into trouble is they think that they're far enough away from that event, and then that event will happen, and then all of a sudden they'll wind up in a margin call and just in serious trouble.
Do you typically sell puts naked, or will you do spreads or condors to control the risk more?
I do all of the above, actually. Naked puts are cashed back puts, so they do hold the cash in your account. That is your safety zone. In that instance, it's very important to only sell the number of contracts of shares that you would want assigned to you at that price. Okay, that's number one. Number two, if you are going to sell a put naked, you need to make sure that you're getting enough premium for the risk that you're taking on. So you wouldn't want to sell something that you're only getting 60 cents for. You know, if you're selling premium, you want to at least get $1 to $2 for every $10 in risk that you're putting on.
Okay. Well, let me ask you this question. If we look at the broader market, we've been in a historically low volatility environment. Are you finding it harder to identify premium sell plays?
Absolutely not. Okay. Absolutely not. Actually, we're having our best return. We've had our best quarter year to date, trading the volatility of the rut. And we're doing that.
The Russell 2000.
The Russell 2000. We do that by doing bull put spreads and bull call spreads, which together make a condor. So you can either leg in on the low side and then add the high side as the market rises, because for the past 9 months, we've been traveling in a channel, and it's a wonderful channel. You sell high up here and you buy low down here, and you use indicators to let you know when to do that. It's extremely important to know what your volatility indicator is for whatever instrument you're trading.
So trading the Russell, what are some
indicators? The RVX.
Right.
The RVX is the volatility indicator for the RUT. So the RVX itself has been trending up and down, up and down, up and down. And when it gets to about the 19 range, that's when you're going to want to add to your bull put spreads.
Right.
When it comes down back into support into the 14s and the 15s, that means the market is going to be up, and you're going to want to add your call side to it.
Right.
When you get those together, you can wind up with $3 and $4 premiums. You do that for a spread of a 10, which would require $10,000 of margin. You're getting in $4 in premium. That's $4,000 on your 10. That's a very good return.
So the market overall, are we still in a channel? Because
Yes,
it feels
we
like,
are.
yeah, we've been
Yes,
kind
we
of
are.
flat-ish, the exception of some pops and drops that we've had.
Yes, we continue flat. We are, in my opinion, in a secular bull market overall. We will eventually break out. I do believe that we will have some sort of a correction, but I don't believe that we will violate the 200-day moving average on the run or the SPX. Therefore, everything that I'm doing is under that and under the existing top that's already been put in.
All right. Well, thank you very much for joining us at the Nasdaq Market Site. All right. And thank you, Facebook, for joining me as always. I'm Joe Malandrino, Global Markets Reporter at Nasdaq.